Hey everybody, in this video we are going to go over the Golden Cross trading strategy, what it is, some ways to tweak it and make it a little bit stronger than it just by itself. So at the chart right here, we are looking at daily chart from the S&P E-mini futures, and the red line on here is the 50-day moving average. The blue line is the 200-day moving average. We're using the exponential moving average for this one. On TradingView right here, this little indicator, it's called the EMA cross alert. Whoever programmed it makes it real easy because basically anytime the red crosses over the blue, it puts a red diamond, and when the red goes below the blue, it puts a green diamond just like down right there. So it makes it really easy to see exactly what bar when we get the crossover for it. Now, by itself, it is a pretty bad trading style to do. You will lose money overall because from what I've read, the market is in a range probably about 70% of the time, although this S&P 500 chart all the way back from 97 does not look like that at all, and it says it's in a trend about 30% of the time, but over here it's definitely not looking like that, because you have, what's the time period from there to there? That's 603 bars, and from that trend, and then in the trend we have 4103. So yeah, not definitely that from what I read didn't seem that accurate for this right here. But for the Golden Cross trading strategy, all you're looking for is, you can go either way. We can start from right here, and we see a crossover happen right here with the green diamond signifying where the 50 EMA crossed below the 200. And typically what it says is you get short right then and there. And then there are two main ways you can look to exit the trade. The first is after you get enter, when price goes and hits the 200 EMA, like right there, you could have gotten out right there for a loss. Or you can wait until you get it cross going the other way, like this red diamond right here. Price goes up and broke above it right there. So if you had done that way, and for this trade, you would have made 295 points on the S&P 500 futures. Now, if it was always that easy, everyone would use this trading style, and no one would make any money because everyone's trying to get in at the same area and get out at the same area. And the reason why it doesn't work is because when you get a lot of turnover, or it's in a range-bound market, you're going to get a lot of signals that makes you have losses. Like here, for instance, here would have been an entry going here to the upside, red crosses over the blue. And then if you're looking down for the 200 EMA, you would have made a very small profit right here. And if you're waiting for a crossover, you would have made another very small profit right here. But then if you want to keep on going and say you want to, you think price is going to break up to the upside right here, there you go. You got an entry candle right here. There's the red crosses over the blue, confirms it, so you get in right down there. But then we have another crossover here down to the downside, so you take it for a loss right there. But then you think, oh man, this is now, I'm waiting for price to go up here to the upside. This is it right here. There we go, getting out of this candle right here. Now what do I want to do? Do I want to wait till the 200 EMA to get out? Because if you do that, you would have had a very nice trade right here at about 124 points. But if you wait for the confirmation for the EMA, you have gotten out right here for a little bit of gain at about 35 points. So that's one of the big drawbacks to this, is the exit. If you're just waiting for a confirmation, come back to the EMA, sometimes it'll work great waiting for the 200 pullback. Sometimes it'll work great waiting for the EMA crossover, like right here. Here you get a crossover. If you just waited for the 200 EMA, you just would have had a little bit of gain. You only would have had, let's see, around 23 points, but if you wait for the crossover going the other way, you would have had about 618 points. So if you get a strong, super strong trend going up one way, it works great. The problem is those don't seem to be too far between, except when you're looking at the S&P 500 chart here over the past about, was that 13, 14 years, it seemed like. So if you had been using it for that, yeah, you probably would have done pretty well, assuming you were going long. But as we can see in here, now it looks like the tide has turned, and we are perhaps starting here to a downside for it. So one of the main weaknesses is it uses a lagging indicator, because the moving averages are lagging indicators. And so all that means is price has to confirm first before it's going to draw where the lines go up. And so I'm not sure if I mentioned this yet, but the 50-day moving average means it takes the previous 50 days bars, averages the price, and then spits it out with the red line. And then for the 200, which is the blue line, it uses the past 200 bars and spits out the price for the average price for it based upon the exponential moving average little algorithm that it uses. So just to recap, strengths of the Golden Cross EMA: easy to see, very easy to see, very easy to use. Has easy entry points, easy exit points for the strategy. But the main weakness is you have to have a trending market. If you're having a range bound market, this thing will not work at all. It'll just spit you out, and you'll be losing a lot of money for it. Like if you go to the, let's see here, we'll go, well, I need to switch these up. Let's go to the 5-minute chart, so it'll look good on here. Like right here, if you're using it here on the 5-minute chart, little intraday trading for it, there you have a crossover right here to the downside, but then it goes straight up right there to 200 for a loss, and then you get crossed over right there for an even bigger loss. And then you have, all right, cool, it's going down the downside, so we'll get in here at this one right there. Oh, but look, it goes up and hits right there again for a loss, or the crossover is right up here for a loss as well. But maybe you wait and you get long right here, and you have a pretty decent setup for it going up over there, whether you take it to the blue, a 20-point gain, or right about over here for about a 22.5-point gain. It's just, it's too hard to decipher and determine when you're going to get a decent sized trend for this to work out before all the losses pile up, when it is when it's just ranging around in there. Let's go back to the daily chart here in the S&P 500, back to the day, and actually we're on the weekly chart. We'll go back to the weekly chart. So there's a couple ways I use it to help discern what you're going to look for in the S&P 500 futures, or excuse me, for any chart basically, for the using the Golden Cross trading strategy. Now, looking at the weekly chart right here, you can see we had a crossover right here, and prices, look at that, price is still going up even to today. It still hasn't crossed over. We haven't had one down to the downside, so that would have been an amazing trade right there for that one, using it. But so the first main thing you want to look for is you want to try to see what's the difference between, is the market trending or is the market ranging. And so the market goes in these waves I look for: 1, range; 2, trend; 3, range. And it's going to repeat that over and over and over again. So all you have to do is remember that: range, trend, range, range, trend, range, range, trend, range. And that's basically it. Because if you look at this going back all the way to October of '97, we have the market was in a ranging market. There's obviously the highs is bouncing off of right there, and then we have the lows right around, probably right about there-ish, pretty close to it. So it's not an exact science. There we have the highs, there we have the lows. So all we're looking for is waiting for this range to break out. It couldn't really go too much lower here down to the downside. I mean, it came all the way down to about 670 points. So I guess obviously it could have, but pretty much the smart money was eventually the market breaking out, and that's what it did right here. We finally had a breakout of this range right here. So when that happened and it didn't come back and test or anything like that, we knew we were off and running right there. So all we do to signify that we are in a trending market is you'll have to redraw these trend line sums. But right now this seems to be pretty much the strongest right there, those two, and then we have going up to right about there-ish or so, we have a trend line here to the upside. And even though, like I said, this isn't an exact science, we did see it did get bumped up a couple times to the top of this trend line. So a lot of times when you see price break out to the upside of a trend line, when the trend is going up, we can expect it here to go back down to the downside and break out of the downside. So what we could be in right now is we could be in a potential range bound market, because there we go again. We go some range from right there to a trend, and now we're just looking for a ranged bound market right there. So all we do is we'll just draw the top right up here, and I don't think the bottom is in yet. I think we'll get a little bit lower, but it could be right about there-ish, say, for the bottom of it. So we'll just keep on seeing what's going to do. But basically what we're looking for is price to break out the bottom of this, going down this way over here, and then we expect price to move in a trend down. Now, it doesn't always happen that way. From going from range, trend, range, it can go range going sideways, obviously, to trend going up, to range going sideways, and then instead of it retracing, price could create another trend channel going back up. So we just won't know until it breaks out of here and confirms it, but right now we're definitely in a trend, and we'll see if this will confirm going into a range. We'll know it's confirmed going into a range when it breaks out of the bottom of the side of this trend channel right here. And so that's one of the ways we look for to determine where we are in the current setup. So just remember that range, trend, range. You can use that for any time period that you are looking for. We can go over here to the 5-minute chart. And you can see from, let's just see, right, let's see if I need to hide this. There you go. So pretty much a naked chart right here, nothing on it. Just want to show here real quick, zooming out, going from range, trend, range. Here we have obviously a range right here. There we have a range going up right there, and now we're looking for a trend going down. So that's pretty easy right there. Going all the way down, and actually it kept on going down about right there. So we have the trend going down, and then we have to start breaking out right there. So that signifies that we were in a range all the way probably back right over there. I'll tell you what, let me see if I can get it to not, I'll have to do it with this one, that's okay. There's a range. And here goes a range here about to the upside, probably about right there-ish. And then we have a range going right there. Then we're looking for, we've busted out of here, so now we're starting looking for a trend going up right there. It looks like the top of the trend channel right there is pretty accurate. So we'll go with the trend right there, and look at that. Fits perfectly down here to the bottom of it. So realistically, price here in the 5-minute chart for the S&P 500 futures, it still is in a trend channel right here. Even though we had a little bit breakout to the downside, we didn't have any confirmation come through it. It's come back up in it, so potentially price is still is in the trend. Now this could turn into being more of like a range here eventually, going from about right there to right there or so. But currently it still is in the trend channel right there. And so that's basically all it is. All you look for is range, trend, range, trend, range, trend, range. That's what the market is going to do. Every single market is going to do that over and over and over again. Now, one other way that we can, let me go back here and let's go back to the weekly chart, is one other thing that we can do is look for it to help determine if it would be looking for a good idea to get into a golden cross trade. Is we can use the MFI indicator. I prefer that over the MACD, PPO, I mean, whatever other indicator, RSI, whatever you like to use. I like to use MFI. It just stands for Money Flow Index. It's supposed to be how much money is going in and out of whatever you are trading. It doesn't work for everything. I don't think it works for Forex, but for the stocks and futures, it does work for it. And all we do down here is, let's see, you get a golden cross signal right here. So you get right here. So you would think, okay, cool, the golden cross, let's get in it right there. Well, you don't really want to get in it because see the MFI down here? You see it's at the oversold level right here. Typically when price gets down in the oversold level, it'll eventually rally up to it. And so there's not a whole lot of steam for the most part. And again, it's not 100%, but it does help filter it out that the price is, its big move down is coming to a halt here pretty soon. And we see it did go down a little bit lower, but eventually it did turn back up. So that would have helped us avoid that trade right there. And then we see for this one right here. So we see, okay, it's going on to the upside. We have a move to the upside right here. Okay, this is coming off being almost being overbought right over here, going to the upside when it happens. So we say, okay, let's just hold off a little bit for buying it until we get closer to the MFI down here at the bottom. And then it does. It comes down here to the bottom right there. It doesn't necessarily go into the oversold territory, but it gets us in at a much better price, because if the price is going to come down, and say you were looking at getting out when the EMA crosses over it, you will take less of a loss rather than being way up here. You know, say you got in somewhere right down here, you know, you would have saved yourself quite a bit of money if you had waited right there. So it helps filter it out a little little bit better. And then you can just wait again until, if you're waiting for the golden cross to happen here, it's going down to the other way right there for it. So those are just two ways to filter the trade out. And then I did one other video regarding the how to do the golden cross trade, but to use Fibonacci levels, and so I'll post that in description below. But basically all it is when you get the golden cross, like right here, all you do is you go and you take the previous low that it was and you draw the Fibonacci levels up here, and you look to take it at a specific Fibonacci level. You know, obviously the 38% would have worked. Didn't even go down to the 50% down here. And then you can add other ones into it. There's the 0.618. There's the 0.886 way down there. You can add to those. And then the exit that you're looking for, I mean, it can be anything you want. Typically the exit I look for is the 1.146 level right there. And then if you want it like kind of an even safer kind of trade setup, you can put stop losses at the different Fibonacci levels, just so you don't have to wait for the confirmation for the golden cross to form the other way. Let me just show you how that would look on the 5-minute chart here. Like I said, I got another video that goes a lot more in depth into it, but just wanted to show this here real quickly. Alright, so here we have a golden cross going here to the upside, so we just take whatever, you know, the previous low is right about down here, and well, that's not the right one. We go right here and we just keep drawing it up till we get the retracement. There we go, you know, hit the 38, 50, 61, but it just blows right past it, and eventually it is eventually going to be a loss. So the lowest stop loss I would have would be just under the 100% level right there, and so that you would have definitely had a loss in this trade no matter where you've gotten in on this Fibonacci levels, but you would have gotten out sooner than you've just waited for the golden cross to happen way down over here. So then we say, okay, we'll try going the other way right here. So all we do is we just draw it, because we have a golden cross down here to the downside. We take it from the previous high over there, and we see, okay, there's could be potential first entry. There's 38, hits the 50%. The X we're looking for is at least the 1.146. Of course, you can take it if you want to take the golden cross the other way. And you see price did come down there and hit that, or if you were looking for that trade to be the exit right there, it hits it off there perfectly before it goes up there and takes it out right there. So this doesn't work 100% of the time every time. We'll just continue doing it. Let's see, that's pretty close. That's probably the low right there. And then if you get a golden cross going the other way, you don't leave this setup on. See here we have golden cross going down, never hit, so we just take it off, and that is how that one works right there. So those are the ways that you look to trade it, and that can help filter it out using the MFI Fibonacci trade setup. And again, if you're looking to see where the price is as far as it's in a range or trend market, just zoom out some, draw your lines on there. Think of it, if it's in a range market, then you're looking for it to break out so it can be in a trend. If it's already in a trending market, then you know eventually price is going to break down. It's going to start being in a range market. Then you just have to see what's going to do there. Is it going to reverse the other way, or is it just going to break out of the range and continue the next leg higher for excuse me, which way it's going. Lose my voice here. But anyways, that is the golden cross setup with a little extra in there. Have a good one. Thanks. Bye.